Welcome to our deep dive into the latest IFRS updates. Specifically, today we're focusing on two significant standards, IFRS 18 and IFRS 19. They are set to, well, kind of change the game for finance professionals like you.
Yeah, these standards, they really aim to make financial statements more useful, more comparable and transparent, which ultimately benefits both companies and investors.
Definitely. So let's start with IFRS 18, which centers on presentation and disclosures in financial statements. Investors have been calling for better information about company performance, and they want to easily compare companies. IFRS 18 is designed to address those concerns.
Yeah, and the interesting thing about IFRS 18 is that it focuses on how information is presented and disclosed, not on how items are recognized or measured. So we're going to see changes in the structure of the statement of profit or loss and in the notes, but not necessarily in the underlying accounting.
So IFRS 18 is like rearranging the furniture, not building a new house.
Exactly. That's a great analogy. It's about making the existing information clearer and more accessible.
Makes sense. So IFRS 18 introduces three major changes. First, a new structure for the statement of profit or loss. This feels like a pretty big deal.
Yeah, it is. The statement of profit or loss will now be organized into three categories: operating, investing, and financing. Plus, there are two new subtotals: operating profit or loss and profit before financing and income tax. This standardized format should make it easier for investors to analyze performance and compare companies across the board.
So it's like we're finally getting everyone to speak the same language when it comes to financial reporting.
Exactly. A common language is key for effective communication.
I completely agree. Okay, the second change is all about transparency for those non-GAAP measures that companies often use. I mean, we've all seen things like adjusted operating profit in company reports, but things are about to get more official.
Right. IFRS 18 introduces the term management-defined performance measures, or MPMs for short. These are essentially a subset of non-GAAP measures that now fall under the scope of IFRS 18. You can think of it as bringing these frequently used but less regulated metrics into the realm of audited financial reporting.
So if a company wants to use an MPM, they can't just throw it out there without any explanation.
Exactly. They must disclose it in the financial statements and reconcile it to the most directly comparable IFRS measure. This means companies have to clearly show how they arrived at their adjusted figures, increasing transparency and helping investors understand what these measures truly represent.
So no more hiding the adjustments in the footnotes. That's a win for transparency for sure.
Absolutely. Investors need to see the whole picture to make informed decisions.
Okay, finally, the third big change is enhanced grouping of information. You can think of it as aggregation and disaggregation. Investors need enough detail to make informed decisions, but they don't want to drown in a sea of numbers.
Right. IFRS 18 addresses this by being more specific about how operating expenses are presented. It also provides better guidance on what should go in the primary financial statements versus the notes, and it emphasizes clear labeling of items. The goal is to make financial statements more user-friendly without sacrificing important details.
Makes sense. I can definitely see how this would be helpful. Too much information can be just as bad as not enough.
For sure, it's all about striking the right balance. We need to provide investors with the information they need in a way that is clear, concise, and easy to understand.
Absolutely. Now let's move on to IFRS 19. This standard is specifically targeted at subsidiaries without public accountability. Imagine you're a subsidiary reporting to a parent company that uses IFRS. Keeping up with all those disclosure requirements can be a real headache. Well, IFRS 19 offers some much-needed relief.
Yeah, IFRS 19 is a voluntary standard that lets these subsidiaries apply IFRS with reduced disclosures. It's designed to streamline reporting, reduce the burden on these entities, and save them valuable time and resources.
Makes sense. Before we dive into the details, could you clarify what public accountability means in this context?
Sure, a subsidiary has public accountability if its debt or equity instruments are traded on a public market, like a stock exchange. It also applies if a subsidiary's primary business involves holding assets in a fiduciary capacity, such as a bank.
Got it. So if a subsidiary doesn't meet those criteria, it can opt to apply IFRS 19 and benefit from these reduced disclosures.
Precisely. And there are some significant advantages for subsidiaries that choose to do so.
Oh, well, let's hear them. I bet our listeners are eager to learn how this could make their lives easier.
Well, first, simplified reporting means lower costs. Subsidiaries can potentially avoid the need for dual accounting records if they are currently using a different GAAP. Additionally, aligning with the parent company's accounting policies can streamline the consolidation process, making life easier for everyone involved.
That sounds like a win-win for both subsidiaries and parent companies.
Yeah, it's designed to be just that. IFRS 19 aims to improve efficiency without compromising the quality or transparency of financial reporting.
Definitely. Now, I'm sure some listeners are wondering, but what about the users of the subsidiaries' financial statements? Won't they lose out on information if disclosures are reduced? It's a valid concern.
Absolutely. However, IFRS 19 has been carefully developed to ensure that even with reduced disclosures, the financial statements still meet the needs of users. The key information is still there. It's just presented in a more concise and targeted way.
So it's about finding the right balance between streamlining reporting and maintaining transparency.
Exactly. We want to make financial reporting more efficient without sacrificing the needs of users.
Makes sense. Now, there's something I find interesting. IFRS 19 is a relatively new standard, but there's already an exposure draft proposing amendments. Is there something wrong with the standard already? I mean, it just came out.
Well, it's not that the standard is flawed. It's more of a housekeeping situation. You see, the International Sustainability Standards Board, or ISSB, had already begun reducing disclosures in IFRS standards issued before February 28, 2021. IFRS 19 was developed after that date, so it includes some newer disclosures that haven't yet been streamlined.
So it's like IFRS 19 needs a little touch-up to get it in sync with the other standards.
Yeah, that's a great way to put it. This catch-up exposure draft aims to reduce those newer disclosures while staying true to the spirit of IFRS 19. It's about ensuring consistency across all the standards.
So this is just a one-time adjustment to bring IFRS 19 up to speed.
Yes. Moving forward, IFRS 19 will be updated alongside any new or amended IFRS standards. We've recently seen this with the exposure drafts on contracts for renewable electricity and equity method accounting, for example. These updates demonstrate that IFRS 19 is designed to be a dynamic standard that evolves with the changing landscape of financial reporting.
That makes sense. It's reassuring to know that the standard is being actively maintained and kept relevant.
Absolutely. It's all about staying ahead of the curve and ensuring that IFRS continues to meet the needs of the financial reporting community.
Well said. Well, we've covered a lot of ground in this first part of our deep dive into IFRS 18 and 19. We've discussed the key changes, the rationale behind them, and how they aim to improve financial reporting for both companies and investors.
Yeah, and in the next part, we'll roll up our sleeves and get into some of the practical applications of these standards. We'll explore some real-world scenarios to help you understand how IFRS 18 and 19 might impact your work as finance professionals.
Stay tuned for part 2, where we'll dive deeper into the details and provide you with valuable insights to help you navigate these new standards. Welcome back to our deep dive into IFRS 18 and 19. In part 1, we laid the groundwork, talked about the big picture changes these standards bring to financial reporting. Now, let's kind of shift gears and get into the practical stuff. How will these standards actually work in the real world?
Yeah, that's where the rubber meets the road, right? Let's start with IFRS 18 and that new structure for the statement of profit or loss. We talked about those three categories, operating, investing, and financing, and those two new subtotals. But what does this look like, in practice?
Well, say we're a manufacturing company. So our operating category would include the usual suspects like revenue from sales, cost of goods sold, and all those pesky selling and administrative expenses.
Exactly. Those are your core operating activities. Then your investing category would include things like gains or losses from selling off property, plant, and equipment, or maybe income from investments in other companies.
Okay, and financing would be all about debt and equity interest expense, dividends paid, and so on. Pretty straightforward, right?
For the most part, yes. But remember those specified main business activities we discussed in part 1. That's where things get interesting.
Ah, yes. The concept that had me thinking about banks and their lending activities.
Mm-hmm.
Can you refresh our memory on how this works?
Of course. It's all about judgment, right? We need to determine which activities are really central to a company's operations. Let's go back to that bank example. If a bank makes most of its money from lending, the interest income and expense related to those loans would be classified as operating. It kind of reflects the bank's bread and butter.
Okay, but wouldn't interest expense usually be considered a financing activity?
Traditionally, yes. But IFRS 18 recognizes that for some businesses, lending is so central that it should be considered part of their core operations.
Ah, I see. So under IFRS 18, we'd see net interest income presented within the operating category for banks like that.
You got it. But here's where it can get tricky. What if a bank also has a massive investment portfolio? Well, the interest income from those investments might be classified as investing because it's not part of the core lending operations.
So it's all about looking at the big picture and determining what activities are truly at the heart of a company's business model. This is where finance professionals need to roll up their sleeves, understand the business inside and out, and use their professional judgment.
Couldn't have said it better myself. And this highlights why clear communication between finance and operational teams is absolutely critical.
Absolutely, yeah. Now let's switch gears and talk about those management-defined performance measures, or those MPMs. This is where I think things could get a bit sticky for some companies, I think. After all, these non-GAAP measures are often front and center in earnings releases and investor presentations. They can be a powerful way to tell a story about a company's performance.
You're right, they can be powerful. But with IFRS 18, the days of, casually tossing out adjusted earnings numbers without a clear explanation are over.
What do you mean?
Companies are now required to provide a detailed reconciliation of each MPM to the most directly comparable IFRS measure. No more hiding adjustments in the footnotes.
So if a company presents an adjusted operating profit figure, for example, they need to show exactly how they got from their IFRS operating profit to that adjusted number.
Exactly. Transparency is key. And companies need to clearly explain why they're using each MPM. What insights does it provide that investors wouldn't get from the standard IFRS measures?
This seems like it will force companies to be more thoughtful about which non-GAAP measures they use and how they present them.
Absolutely. It's about making sure the information provided to investors is meaningful and not just designed to paint a rosy picture.
Okay, I see what you mean. Let's move on to IFRS 19 and those reduced disclosures for subsidiaries. As we discussed in Part 1, this standard is all about streamlining reporting and easing the burden on these entities.
Right. It's a welcome change for many subsidiaries that have struggled to keep up with the extensive disclosure requirements of full IFRS.
Definitely. But let's get specific. What kinds of disclosures can subsidiaries actually eliminate under IFRS 19? Give us the nitty-gritty.
Well, for starters, they can significantly reduce the level of detail they provide in the notes to the financial statements. For example, they might not need to disclose as much information about related party transactions or segment reporting.
That makes a lot of sense, especially if the parent company already provides that information in its consolidated financial statements.
Yeah.
No need to duplicate the effort.
Right. IFRS 19 recognizes that some information is already available at the group level, so there's no need for subsidiaries to reinvent the wheel.
So it's a win-win situation. Subsidiaries can simplify their reporting, and the overall transparency of the group's financial information isn't compromised.
Exactly. It's about working smarter, not harder. And it also helps ensure consistency in accounting policies across the group.
But wait, I'm sure some of our listeners are thinking, does this mean subsidiaries can just omit anything they want? I mean, there have to be some limits, right?
Of course. IFRS 19 doesn't give subsidiaries carte blanche to leave out crucial information. They still need to disclose information that's relevant to the users of their financial statements. It's all about finding that sweet spot, providing enough information to meet user needs without going overboard.
So while IFRS 19 provides a framework for reduced disclosures, it still requires careful analysis and decision-making.
Absolutely. There's no one-size-fits-all approach. Each subsidiary will need to tailor its disclosures based on its own unique circumstances and the needs of its stakeholders.
It sounds like professional judgment plays a key role here. Finance professionals need to carefully assess the specific situation of their subsidiary and determine what disclosures are truly necessary.
That's right. This is where deep knowledge of the standards and the underlying principles comes in. It's not just about ticking boxes. It's about understanding the spirit of the standard and applying it in a way that makes sense.
So we've dug into some practical examples of how IFRS 18 and 19 might play out in the real world. But I have a feeling this is just the tip of the iceberg. There's so much more to explore, What are some of the broader challenges and opportunities that these standards present? Let's discuss those in Part 3. Welcome back to the final part of our IFRS deep dive. We've unpacked the key changes in IFRS 18 and 19, explored some real-world applications, and now it's time to zoom out and consider the bigger picture. What challenges and opportunities do these new standards present for companies and, finance professionals like you?
Yeah, that's a great question. Let's start with the challenges. Implementing these standards, especially IFRS 18, will require a pretty significant shift in how companies think about presenting their financial performance.
Yeah, I imagine it's not just about number crunching. It's also about changing how companies communicate with investors and other stakeholders.
You're absolutely right. It's a communication challenge as much as a technical one. Companies will need to invest time and resources in, understanding the new requirements, training staff, updating their systems and processes, and then they'll need to clearly explain these changes to investors, making sure everyone understands the new format and terminology.
Yeah, sounds like a lot of moving parts.
It is. And another challenge is the increased need for judgment. Both IFRS 18 and 19 involve more judgment than previous standards.
Yeah, that's a double-edged sword, right?
Yeah.
On the one hand, it allows companies to tailor their disclosures to their specific circumstances. But on the other hand, it could lead to inconsistencies and comparability issues, especially if judgment isn't applied consistently across the board.
Exactly, that's the crux of it. Finance professionals will need to develop a deep understanding of the standards and the underlying principles to make sound judgments. They'll also need to be prepared to defend their choices to auditors and regulators.
Right, and this is where strong documentation and clear audit trails become essential.
Absolutely. Now, let's not dwell solely on the challenges. Amidst all these changes, there are also some exciting opportunities. IFRS 18, with its focus on transparency and comparability, has the potential to, really enhance investor confidence and trust.
And that's a big deal in today's world. Investors are demanding greater transparency and accountability. If companies can embrace these standards and demonstrate a commitment to clear communication, it could really give them a competitive edge.
Yeah, I agree. And for finance professionals, these standards offer a chance to showcase their expertise and add value to their organizations. They can become the go-to experts, guiding their companies through the implementation process and ensuring compliance.
Right. It's an opportunity to step up as a strategic advisor, not just a bean counter.
Exactly. And let's not forget about the benefits for subsidiaries under IFRS 19. Reduced disclosures can streamline reporting, save time and money, and free up finance teams to focus on more strategic initiatives.
For sure, it's a chance for subsidiaries to shake off some of that administrative burden and play a more active role in supporting the group's overall financial goals.
So as we wrap up our deep dive into IFRS 18 and 19, it's clear that these standards represent a significant shift in the financial reporting landscape. They bring both challenges and opportunities for companies and finance professionals alike.
It's an evolving landscape, and staying informed is key. We encourage you to explore the resources in our show notes and, continue to deepen your understanding of these new standards.
Remember, the journey toward more transparent and comparable financial reporting is an ongoing one. And by embracing these changes, we can all contribute to a more informed and efficient capital market.
Well said. That's a great note to end on. Thanks for joining us on this deep dive into the world of IFRS. Until next time, stay curious and keep learning.